All right, welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at ticker GS, Goldman Sachs, one of the largest investment banks in the United States. It operates also internationally, also does a little bit of consumer banking as well, but mostly investment banking. We'll get into that. Most people are pretty well familiar with them sort of anyway. Coming over to our watch list briefly to take a look at a few of the things that's kind of going on in here. I had commented on our last stream about the fact that one of our previous valuations that we did recently had actually moved down a little bit more. I'm looking at that even more, which is Zim integrated shipping. I've noticed that we've actually gotten quite a lot of views recently from that particular stream. Definitely seems like a lot of people were very interested in getting somebody else's idea on possibly the valuation for that company. So if you're new to the channel, because of possibly seeing that stream or possibly subscribing because of it, well, welcome. Here we are taking a look at another company. Goldman Sachs also kind of completes a little bit of a small circuit that we're doing briefly into the larger money center banks inside the United States, as well as that are also partially investment banks. I had also done Citigroup as well as JP Morgan, and now I'm doing Goldman Sachs. And as I kind of said with when I started doing this little grouping, is that it's not necessarily to say that the three are super comparable to each other. That isn't necessarily the reason why I chose to do those companies, kind of some outside of investing reasons for why I was doing them. I was just interested in taking a look at them regardless. But regardless of those outside reasons, they had screened relatively well in my kind of screening tool that I use for deciding if companies are worthwhile of doing in the near term, of which I do have other possible ideas for the potential streams in the future. Though it is worth noting that actually the next stream I have planned is actually pretty much already slated to be ticker SFRRF, Sandfire Resources, a copper miner, which we've covered on the channel before. It's one of my personal holdings, as well as they recently released their annual report so for the 2022 year. And so I've been very interested in updating my valuation for that. So that's what we can expect to be coming out next in terms of valuations on the channel. So before we get into the valuation, I would ask that if you're watching at this point, whether live or on the replay, please give us a like. It'd be very much appreciated. More likes helps attract more viewers to the channel. And if you're not already subscribed to the channel, please subscribe to the channel. That way you get notifications whenever I go live or when I release other videos and things like that. And in relation to viewership and subscribers on the channel, I kind of wanted to call attention to it. We actually just today reached 200 subscribers. Actually says 202 down there at the bottom. We soared past the 200 mark last night, which is pretty cool. I'm pretty happy and proud of it. This graph I have right here shows in red the total subscribers of the channel. It's not updated to today, so it actually still has it at 199, which is where it ended last night. But the blue line is the 30-day daily average views for the channel as well. So you can see that that's also been moving upward in a very nice rapid pace. I'm very proud of the movement of the channel. This is the graph that I like to look at on a daily basis rather than stock charts. You know, stock charts are looking pretty doomy and gloomy lately, but this chart makes me happy every single day. So I'm very happy, and thank you to everybody who's kind of helped get us to the 200 subscriber point. Far more distance to go to get to 1,000, but that's where we're trying to get to. And on that note, if you haven't watched my most recent short video that I put out, where you can learn to invest online for free through lots of resources from Aswath Motoron, I would like to call attention to that video, which is a little bit outside of the normal ring of valuation streams that I do on the channel. So if you haven't watched that, please check that out. All right, so we'll get into the Goldman Sachs valuation now. Hey man, Nukit, what's up? Welcome to the stream. I can always count on you to show up in the channel. So Goldman Sachs was founded in 1869. As I had said, they operate entirely in the United States, USD, New York Stock Exchange, same as all the other bigger banks, having all their links listed here. The current CEO is David Solomon. He was elected to CEO in 2018, and he joined Goldman Sachs in 2006. He's been with the company for quite a long time. I put them in the capital markets industry as opposed to the money center banks, so that I'm kind of qualifying them as being a little bit different from the other two banks that we covered already. Admittedly, because Goldman Sachs has a lot less of a deposit consumer deposit focused part of their business, they're definitely much more on the investment banking side. They do have some consumer banking, so that we're clear, They've been expanding more into the consumer banking parts of their business over the last few years, but it's still a relatively small portion of their revenues and their assets under management. So I am going to kind of segment them a little bit differently into calling them capital markets. Top competitors, though, still kind of in the same ring of companies that we've been kind of comparing them all to. Morgan Stanley, JP Morgan, Citigroup, Wells Fargo, Bank of America, many more others you could theoretically list. As according with the last call that they had, the next expected report date that they have would be mid-October on the 18th. And I did not find specific guidance in the presentations or in their transcripts that they specifically gave. They gave some longer term, midterm targets, which I'll kind of cover in just a brief moment, but they're not really specifically like guidable kind of targets. They're more like target ranges for returns and efficiencies and stuff like that. So not very useful for guiding our actual projections. So kind of left that blank. The analysts on Yahoo, however, are guiding for the 2021 fiscal year to come in at 47 billion or so in revenue, which is according to 20 analysts, and about 50 billion or so for the next year, according to also 20 analysts, with the EPS coming in at $34.70, according to 23 analysts, and $38.49 for next year, according to 23 analysts. Their trailing 12-month dividend, well, actually, it's not the trailing 12-month. This is actually the dividend for the 2021 fiscal year. So we're doing technically the trailing 12-month in the fiscal year would be a little bit different in this case. But the 2021 dividend was $6.50 per share, and then the forward dividend, because they recently announced the increase of 25% off of the actual trailing 12-month, which was $8, and so now it's up to $10 per share in a forward dividend, which comes out to about 3% or so on a forward expected yield. They also do have about 10.5 billion in share back authorization, which equates to about 9% of their market cap. Though there's not necessarily to say that they can use that 1 year. And it is also worth noting that it's not dollars that they have authorized, it's technically 31.5 million shares. They have a share authorization rather than a dollar amount authorization. Companies decided to do it different ways. Personally, I prefer a dollar amount authorization because what it means is that they're going to end up only being able to purchase up as many shares as the dollar amount is available, which means you're going to automatically have a sort of dollar cost averaging built into the buying process. So personally, I like it when companies say we're going to buy back 10 billion, because that means if the share price rises by 50% the next day, that means automatically they're going to end up buying less shares, so it kind of has an auto regulating feature if you do it in dollar amounts rather than share amount. But I digress. They have it authorized accordingly to shares, 31.5 million shares of authorized buyback. The insider holding is less than 1%, about 0.5% or so, so not very substantial insider holding, but it is a pretty large company. So the larger the scale of the company, the harder it gets to have a more substantial insider holding. However, the insiders that do hold, there has been a little bit of increase in the last 6 months, but only about 5% on net increases. So not a dramatic increase, but at least a partial amount. As I had just said, a pretty large company. So as a result, the idea that 71% is held by institutions should be no surprise. That's pretty par for the course for such a large company like that. And 1.63% of the outstanding shares is currently being shorted. The short of float is basically the same because, again, a pretty large scale company. Short ratio being 2.16 days. So the investors that are shorting basically have no real risk to their ability to maintain those short positions for longer periods of time. The 3-month average volume is 2.36 million shares versus the 10-day average volume of 1.73 million shares. So it has been relatively weak in the last 2 weeks or so comparative to the last 3 months. And so now we'll get into a few of the specific information that I thought was interesting in their presentation, as well as in the letter to the shareholder from the end of 2021 from the CEO, which that actually shows the CEO as well as the chairman right there, Mr. Solomon, and then the chief financial officer as well as president and COO. So the kind of 3 key men. But this is kind of what I was talking about in terms of some of the kind of midterm goals that they present. They talk about their kind of longer term strategy. I'll just kind of read it off right here. Confident in our strategy, we recently unveiled an updated set of financial targets. In the medium term, we believe we can achieve return on equity of 14 to 16%, return on tangible equity of 15 to 17%, and also reaffirmed our target efficiency ratio of 60%. So yeah, they kind of have these midterm targets that they talk about right here. I didn't read fully to find out exactly what in terms of efficiency ratio they mean for this. This might be a return on asset kind of turnover ratio, but I didn't actually look into specifically what it was. I do understand what they mean by these, but I also have my own ways of calculating these metrics. So that, which I've kind of talked about with some of the other banking companies. But they do also talk about some firm-wide targets as far as like growth initiatives that they have for the company. In addition to our firm-wide targets, we unveiled an updated set of business-level targets tied to our growth strategy. Our new targets include 350 billion in organic, traditional, long-term fee-based assets, assets under securitized net inflows over the period from 2020 to 2024, 225 billion in gross alternatives fundraising over that same period, and more than 10 billion in firm-wide management and other fees in 2024, including more than 2 billion from alternative assets under securitization, approximately 750 million in net revenues in transaction banking in 2024, and over 4 billion in net revenues in consumer banking in 2024. So they are expecting to essentially grow their overall revenues, according to this, by somewhere in the range of around 11 to 12 billion by 2024. And then this was also something that they had put in place, I believe, at the end of 2019. So if you kind of like comparatively see that, you can actually see that they're well on their way to making those goals at the end of 2021, though there is, as we had said, a bit of a dip in the revenue expected this year to go down to 47 billion, which is a downward move in their revenue. So to get there by 2024, I guess they would kind of have to make a little bit of a leg up. But in terms of at least being halfway through the time frame, they are at least kind of halfway through the supposed goals they have. So also coming into their earnings presentation from the second quarter to point out a couple things. I'm not really necessarily going to talk too much about this, but their book value did increase over the last quarter, which is interesting to see that their book value was increasing even though their revenues from the capital markets were decreasing dramatically. But I did want to show also their revenue mix, at least according to the most last quarter. You can see that they get 9% of the revenues from asset management, 18% from consumer and wealth management, which this is the part where the consumer banking is sectioned into. I think it's about half of this, but it's further down in the slides. And then 18% from investment banking, which includes a lot of underwriting of both credit and equity transactions, a lot of underwriting security transactions, and then 24% from equities, and then FICC, which is their fixed income, currency, and commodities revenues. So they actually get a pretty huge section of their revenues from fixed incomes, commodities, and currencies, alternative kind of assets in the capital markets. And then coming down to more subsectioning between the different segments that they have, which shows kind of what I was talking about. Investment banking split up into financial advisory, underwriting, and corporate lending, and then the global markets sectioned off into equities, and then the FICC grouping. And then this is kind of what I was talking about, the asset management fees here, and then the consumer and wealth management being 1.57 billion, and the consumer banking being 608 million. So 608 million out of I believe the quarterly revenue was around 12 billion. Yeah, 12 billion or so. So 600 million out of 12 billion or so. That comes out to be about 5%. 5% of the revenues coming from consumer banking. So definitely much less so than comparative to Citigroup or JP Morgan, just by comparison. So we can get into I can take a look at the actual segmentation that I've kind of put into the company. So kind of putting that groundwork to kind of explain the difference between Goldman Sachs and JP Morgan and Citigroup in particular, gets me to explaining that I'm actually using the wealth management and investment banking segmentation rather than the banking money center segmentation, which gives them a slightly lower unlevered beta relative to the other two companies. And also gives them a different sales to capital ratio, industrial expectation, as well as net margin expectation. So that's just kind of why I essentially laid in those points over and over again, was to kind of explain why I'm treating this one slightly differently, giving them a slightly better beta. And then also you can see the sales capital ratio for the money center banking, it was 0.27, I believe. And so for investment banking, it's 0.61, a slightly higher sales capital ratio, and also higher margins for the grouping, at least last year, because the money centers didn't really have any profits to speak of last year due to a lot of write-offs as the industry, versus investment banking had a great year last year. So it's a little bit of a difference you can see in the industry. Though in Goldman Sachs' case, I'm pretty sure they have a lower sales capital ratio than their industrial grouping and higher net margins than their industrial grouping, which generally, like I said, you're usually higher on one and lower on the other. So taking a look at their geographic segmentation, they get about 63% of the revenues from the United States. So that's another thing that I kind of like about them relative to the disbursement of the revenues in JP Morgan and Citigroup. They had kind of different sets of revenues, which in fact I'll actually kind of come over here to show that, because I do have both of them open. What was it? It was 79% of the revenues for JP Morgan comes in the United States, and I think it was, what is it, in the 30s or something for Citigroup. Yeah, 38% for Citigroup. So you can see that kind of Goldman Sachs is a little bit between the two. JP Morgan's still a little bit more US focused, but Goldman Sachs is definitely a lot more US focused, which does lower their equity risk premium, which gives them a slightly better positioning as far as their overall discount rate. Coming up with the equity risk premium of 6.29, the unlevered beta of 0.83 is then levered up by the debt to equity ratio, which comes in at 230%, which brings them to a beta of 2.22. This brings their entire cost of equity up to 17.25%. And again, that's 231% debt to equity ratio, that coming off of a market weights of their debt to equity, their market cap being 115 billion currently, and then the total debt that I have accordingly for them is 267 billion, including lease liabilities, at a weighted average maturity of 5 years and interest rate of 3.11%. So pretty good interest rate. Not the greatest maturity, at least it's 5 years, but that's kind of like the minimum I like to see. It would be better if we could see a longer maturity profile for their debt, but at least they have a pretty good interest rate. And at least they don't have quite as high of a debt to equity ratio as Citigroup does, but still significantly higher than JP Morgan's does. So their cost of equity kind of comes in between the two. What was it for both of them? I can't quite remember. JP Morgan had 12.5% for their cost of equity versus about 20% for Citigroup. So Goldman Sachs at 17% is a little bit between the two, still leaning a little bit more towards the higher end of things. So we'll take a look at their financial history, the period between 2012 and 2021. You'll see that their revenues went from 41.6 billion up to 64.6 billion over the 10-year period. Pretty consistent rate of growth. They had not really that much rate of growth for the first 5 years. It was basically flat, just kind of actually having lots of down years, and then one kind of growth spurt year in 2017 to kind of basically make up the lost ground and make them relatively flat over the entire time frame. And then they had a little bit more of still rocky period for the next 5 years, but at least more positive years than negative for the next 5 years, including a pretty strong year in 2018 and then a very strong year in 2021, which brings them for the second 5-year rolling period a CAGR of about 11% per year. So being flat for about 5 years and then about 11% CAGR for the next 5 years, overall coming out to be a pretty significant amount of growth, coming up about 50% over the entire 10-year time frame. And so this is kind of what I was saying before, them being at 64.6 billion in total revenues, and then in 2019 they had 52.8 billion in total revenues. You can see that they've actually already grown about 10 billion or so, a little bit more than 10 billion in total revenues. And then if you disaggregated where the revenues actually came from based off of the segmentation of their mix, that shows the large progress that I was talking about in terms of those growth initiatives that they had laid out, that they were talking about in the letter to the shareholders. So coming down the line, also to take a look at their net income margins, you can see their net income margins over the period. Nukit, gotta go, gonna watch the stream later. Thanks for the interesting series. Yep, catch you later. Always appreciate having you on the stream. Thanks for watching. Yeah, so take a look at the net margins. You can see for the first 5 year, they averaged about 21% for their net margins. For the next 5-year period, averaging also still about 21%. So even though they had, like I said, a pretty volatile set of revenues, having lots of down years over the 10-year time frame. In fact, what is it? Pretty much half of the years came in, 4 out of 9 of the year-over-year periods. About half of the years had downward moves in revenue, and yet the margins themselves remain pretty consistent, at least on a longer term average. There is some deviations within, 9% being the low point here, 32 to 33% in the most recent year. So there is still deviations within the margins, but no negative years in the margins, and overall still maintaining that consistent average over these periods. So like 20% for the first 3 years, 17 to 18% for the next 3 years, 21% for the next year, and then like the last period, including that most recent year, 24 to 25%. So, you know, a little bit of deviation if you kind of break it down maybe into like rolling 3-year periods, but still relatively consistent margins and maintaining it over the longer term time frame. So I think that shows a pretty strong consistency in their business model as well. Coming down to the free cash flows to equity, you can see that the cash flows that they had available to pay out to their shareholders after adjusting for the total amount of debt being issued by the company, that for the first 5 years comes in at about 15.7 billion per year they could have paid out to their shareholders. The total amounts that they did pay out to their shareholders was 7.4 billion. So really only paying out about half of the cash flows that they theoretically could have for the first 5 years. In the next 5 years, they averaged 34 billion per year on average that they could have paid out to the shareholders. and then the amount that they did pay out ended up being about 8.1 billion. So they increased the amounts that they were paying out to their shareholders on average over the entire time frame, but it on net is actually becoming a much smaller percentage and ratio of the total amounts of their free cash flows to equity. If we kind of take a look over the entire 10-year time frame, it averaged 24 to 25 billion per year, and then the amount that they were paying out 7.8 billion. So really only maybe about 35% of a total common payout ratio comparative to free cash flow to equity. For example, we can just take a look at their total common yield. Total common yield, well, of course, it's, hold on just a second, let me use the function because the simple average doesn't want to be very helpful to me right now. Just getting an average of their total common yield over the 10-year time frame, average about 10%. So shareholders were receiving about a 10% total common yield, and even so, that only was coming in at about maybe a third of the total cash flows that they could have theoretically paid out. So they could have been paying out possibly a 20, 25, maybe even 30% total common yield, and they wouldn't have been overpaying the cash flows out to their shareholders, according to the way that I'm calculating the cash flows. You could also argue that this puts them in a pretty good position for their balance sheet, which we'll definitely get into in a moment. It's coming down to take a look at the returns on invested capital. Let's see, the returns on invested capital were, for the most part, pretty low single digits, or not necessarily low single digits, but pretty middling single digits, 4.5% for the entire consistent time frame up until this very, very strong return year in 2021, which is not uncommon. This does get into something that I kind of commented on with my other valuations for the other financial groups, because it was true for both of them. And it's true for a lot of other companies, but it's definitely true for the financial companies in particular. The ways that I like to calculate returns on invested capital is that I calculate it including book equity and plus the total amount of debt issued by the company. But the book equity, I subtract out cash because I don't count that as capital being employed in the business. So we're counting the debt and the equity, subtracting out the cash, so to get an idea of the total amount of capital that's actually being employed in the business. And so if you have a significant amount of cash and a relatively small amount of equity, then it's very easy to end up with a negative non-cash equity as a result. And you can see that that's true for Goldman Sachs, because this return on equity that they return for all 10 years ends up being negative because of the fact that they have large amounts of cash and a relatively thin line of book equity comparative to their total asset base. It's a pretty significant amount of book equity comparative to like market cap of many companies, but considering their total scale of their assets, it's very, very small, which is true of lots of financial service companies. They usually have huge amounts of assets, huge amounts of liability, and a very, very thin slice of shareholders' equity. That was true of the other financial companies I did as well. And they also had this issue of which I'm talking about, which is to say that whenever I have a negative shareholders' equity, I don't feel that I can rely on the historic range of the returns on equity or returns on invested capital to give me an accurate measure. And instead, I take the most recent year of return on invested capital and I just cut it in half. But the premise of this kind of basic, very, very simple rule of thumb, because it is very, very simplistic. The reason why I use this logic is I say that the debt counts as a portion of their capital that is more consistent, and then the negative equity is the part that has to become positive. And at minimum, I'm essentially assuming that they need to double the book value essentially to replace that negative shareholders equity with positive shareholders equity. So I just essentially cut the returns on invested capital in half, because I'm assuming that they keep the same returns and then they're doubling their book their capital, which means you're cutting the number in half. So 20.23% was what they had in the most recent year according to this calculation. I'm saying a more sustainable measure of what they had done over a 10-year time frame might be something like 10%, which, I mean, you can compare that to the actual average over the same time frame, and the average ends up being 6.34%. So I'm essentially adjusting upward in this case. For a lot of other companies, that ends up being an adjustment downward. But I think this also helps me make a little bit more of an estimate on where I think the returns on invested capital are also going to go in the future, which helps me make projections, because one of the things I do in my evaluations is I take the assumptions, including the margins, the revenues, and the capital assumptions I all did, and I calculate what the return on invested capital would be at the end of the 5-year period based off of the assumptions I put in place. And so I can compare that to this number here to get an idea of just how aligned it is with the logic that I'm trying to establish here. So anyway, kind of long rambling way to explain this methodology, even though I know I've kind of explained it basically in my last 2 valuations already, and I've explained it several times before in the past, but it's something I kind of feel the need to explain all the time, because only earlier today I was explaining, in fact, to our buddy Nukit that was in the chat earlier, basically the implications of shareholders' equity for a lot of companies, because it's something that can have a lot of negative effects if you don't understand it, but it may not necessarily affect it at all in the shorter or medium term. So anyway, coming down to the balance sheet, you can take a look at their actual assets they have on hand, seeing kind of what I'm talking about, the huge amount of cash that they have on hand. For the first 5 years of the historic time frame, they average about 81.3 billion in cash on hand in any of the given years. For the next 5 years, they average about 158.2 billion, and then they ended the period with 261 billion in cash. So huge amount of cash on hand. We can compare that to total amount of their assets. The total amount of their assets on average for the first 5 years being 885 billion. So 885 billion comparative to the 81 billion, that comes up to like less than 10% of their assets being in cash. And then in the next 5-year period, it being about 1 trillion or so in assets, versus what was the number ended up being about 158 billion or so. So that ends up being about 15%. So they went from less than 10% of their assets being cash to being more about 15% of their assets being cash. So you can see that there definitely has been a growth in total percentage of cash on hand as a percentage of their assets. And they do also have a huge amount of marketable securities, but those marketable securities are a little bit more key to the actual operations of the business. In fact, the cash is key to their operations of their business too. That's the thing that makes financial service companies a little bit different, which is why I say that you usually do find this problem with financial service companies. Anyway, coming down to their total liabilities, you can see that their liabilities are also pretty substantial. For the first 5 years, averaging about 812 billion. So 812 billion versus the 885 billion in total assets. You can kind of see how thin the line of equity that I was talking about is, and that's pretty consistent even through their whole history. So again, 1 trillion, 1.1 trillion for assets, and then the average assets for the next 5 years was about 1 trillion. So that very, very thin line of equity, 1.4, 1.5 trillion to 1.3, 1.4 trillion here. The shareholders' equity being very, very, very thin. Ends up being 73 billion, which, I mean, 73 billion, as I had said before, it's like in nominal terms, that's actually a huge amount. 73 billion is much larger than the market caps of most companies. But still, compared to the total amounts of liabilities and total amounts of their assets, it's a very, very thin margin, which is sort of what I was talking about, and definitely less than the total amount of cash that they have on hand. As I was saying before, it's like if their shareholders' equity ends up being 73.5 billion, but they had 81 billion on average in cash, then you can see that the cash more than outweighs that equity, which is exactly what I was talking about. Coming over into the most recent year of shareholders' equity, 99.2 billion. So going from 69.5 billion up to 99.2 billion over the 10-year time frame, you can see that at least the shareholders' equity has been growing very substantially. So even though there is this thin margin between the assets and the liabilities, what that does provide for Goldman Sachs is a very strong ability to leverage up their equity over time. You can see that the growth of their shareholders' equity is pretty well in line with the growth of their revenue, and that would be pretty well in line with the growth of their stock over time as well. Although their stock actually has outpaced it, I'm pretty sure. But that could also be off of the expectations that leveraging could continue in the future. And it's also worth noting that that their ability to retain earnings has also been growing substantially over time as well. So that also shows that they haven't been overpaying the shareholders. But as I had said, I had kind of made the point with the cash flows that was pretty clear. They're only really putting out about a third of what they could have. They have tons and tons of assets on their balance sheet, but part of the reason they're probably not paying out as much as that they theoretically could have is because that would actually mean that they would have to liquidate and separate out a lot of the liabilities in order to do so. So coming down to the sales to capital ratio, you can get an idea of just how they finance their business. And this is kind of one interesting thing that I found in their business, that they had a relatively low sales to capital ratio pretty consistently for the first 5 years, averaging about a 0.09, which is really, really low. In fact, dramatically low, much lower than their industrial expectation of 0.61, even lower than the industrial expectation of the money center bankings. And then it's actually moved up pretty consistently over the next 5 years until skyrocketing in 2021 to 0.49. So kind of trying to think about like where we think that can move over the longer term time frame. It's going to probably come down from 0.49, but it probably can't come down too dramatically quickly. But like where we think it will come down to is going to make a big effect on our valuation as a whole. But it also is worth noting that even in line with their skyrocketed to 0.49 in the most recent year, it's still low relative to the industrial expectation. So even though they were much lower than their industrial expectation before that, even with the most recent gains, they're still lower than that. And then, as I had pointed out, the net margin being about 15 to 16% for the industrial expectation, they have higher margins than that in the most recent year, about 32, 33%. So lower sales capital ratio than their industry, but a higher net margin than their industry. So we can start to take a look at the projections that I put together for the company. I did put together a revenue model, which I've kind of already have shown in my previous valuations, what with the fact that it's a revenue model that's put together in and described the same as it is for the JP Morgan and the Citigroup valuation that I did, which is to say that I took the average daily 10-year treasury yield that was available during each of the years of the financial history, and took a record of how that rate has moved up over time, and took a correlation of that to the revenues of the company. The logic of this being is that financial institutions, primarily banking institutions and investment banks, any business that does its business is basically lending out of money, or borrowing money from at one rate and lending out at another rate, will profit off of the rise of interest rates because they make their money off of the spread between those interest rates. And so whenever interest rates move up, that gives them the ability to capture on the fact that the interest rate has moved up based off of the fact that they already made loans in the past off of the previous interest rate. So when interest rates move down, it makes it harder for them to make new revenues. When interest rates move up, it makes it easier for them to make new revenues. And then we did this consistently across all three of the companies, getting an idea of just how well correlated the movements in the 10-year treasury is to the movements in the revenues. We get a 74% correlation for Goldman Sachs, with a 54% R square, which means 54% of the trend is explained by this 74% correlation. For JP Morgan, we had about 74% with also about 54% for the explanation. Those are surprising how equal those two actually are. And then Citigroup, it was actually more like 87% correlation with a 75% explanatory factor. So either way, pretty strong statistical correlation with explanatory capability across this logic. And then for each of the companies, I also use a 7% upper bound and a 1% lower bound. That's not even necessarily to say that in 2026 the interest rate would be at 7% or would be at 1%. What that means is that effectively Goldman Sachs would be able to capture on the movement change between the current rate, which is 3.25, 3.26%, upward to 7% or downward to 1%. Based off of that correlation, based off of the correlation that the model puts together, we end up with an expected revenues based off of the 7% interest rate movement up to 94.5 billion for Goldman Sachs. And if it was to move down to 1%, we would see revenues of possibly 54 billion. So that gets us a pretty wide range of revenue expectations. And this is the same methodology that I use for the other two institutions. It is also worth noting that I did think about this after the fact, because I kind of came up with this methodology for these three companies and valuations. And I did think about the fact that I've done other financial institutions in my watch list and thinking about like how this would affect them as well. And so, for example, if we come over to my watch list and filter by sectors to get them into financial order, we can highlight all the financial companies that I have valued here, other than the ones that we've already done here. There's Virtue Financial, as well as Invesco and Jefferies Financial, T. Rowe Price, and Fidelity National Financial. And I was kind of trying to think about like, well, which of these companies do I think this methodology could maybe benefit the valuations of those companies? And I don't think it's really actually applicable for a lot of them. So the fact that I haven't used that methodology in them isn't necessarily a problem. In fact, there's really only one of these companies that I think maybe that methodology would be beneficial for. Not Fidelity National Financial, because that's more of an insurance company, so it has a little bit of a different setup as far as how its revenues are produced. And not T. Rowe Price or Invesco, because those are asset managers that are a little bit more making their profits based off of fees related to the funds that they have specifically. And then I wouldn't do that for Virtue Financial, because they have a little bit more of a focus in the liquidity movements of capital markets specifically. So I do think perhaps that methodology could possibly be useful for Jefferies Financial, and I do plan to possibly go back and do a little bit of some side work on my own to see what I think the correlations would be for the revenues for that company and compare it to my current valuation for that. I'm probably not going to do a separate stream for that, so don't be expecting me to do like an updated live stream based off of that necessarily, but it is something that I did think about with using this model for these three companies. I was like, well, should I have used that model for other companies? And well, you know, if it can be logically applied to them, then yes, I should maybe use that model for it. So I think that could maybe apply to Jefferies out of the group, but maybe not the other ones. So let me reorganize my watch list back into order by value score, and then we'll come back over to Goldman Sachs. So with the 54 billion and the 94.5 billion as our expectations, I come over here to the actual valuation, and you can see that that's kind of basically where I've put the end revenue projections for 2026 for them. kind of going to 53.5 and 96.9 billion, and then kind of flying between the line here. Now, in the short term, I do have it drop basing according to its 9-year average, which gets us about a 21 to 22% decline in revenues in this particular year that we're currently in, which is somewhat in line with the expectations of the analysts. As we had said, there is expectations of the 2021 revenues coming in, our 2022 revenues coming in at 47 billion according to 20 analysts, and then moving up to 50 billion in next year. So 47 billion is the expectation. The expected revenue that I actually have accordingly with this is actually at 50.6 billion. So it's a little bit lower or a little bit higher than that. So you could argue that I could actually make this a little bit deeper than that, but I'm okay with this assumption in line, because really it's just more of a short-term movement, and it's going to affect the short-term earnings, but really the vast majority of the valuation comes off of these long-term terminal numbers. So those that make sure that part's accurate, it's the part that's more important to me. So coming down to the net margin expectations, kind of taking a look at that, as I had said, they have managed to maintain this kind of 20% pretty consistently throughout their valuation. So I feel pretty strongly about that. And since I do have such a strong downward movement in the revenues, that has a pretty strong effect on their immediate expected profits. So I feel pretty confident about just kind of leaving the margins as that kind of long-term average. And I do see their net margin kind of sustaining that self over the longer term. I have it as on kind of a band between 10% and 35%, which gets us a midpoint of 22.5, and it kind of leaning it up towards 23-24%. So it is a little bit more optimistic, I guess you could say, as far as that goes. But honestly, considering, like I said, the consistency of their margin and not having negative years even during the more volatile years of their revenue, kind of makes me feel a little bit more strongly about their ability to kind of sustain these margins and moving forward. So that's one of the reasons I kind of left that lean a little bit more positively to the upside. Coming down to the sales capital expectations, as I had said, they currently have a sales capital of 0.49, but they had traditionally always had a much lower sales capital ratio over the 5-year most recent year period, it being 1.19. And their industrial expectation being 0.61. So I'm kind of seeing them possibly maintain their kind of more recent 5-year average as more of a sustainable kind of thing, but they do have the 0.49 is where they currently have. So they'll move from this towards 0.19, and I do see them kind of having an expected ratio of about 0.33 after having attributed a 0.1 to 0.3 kind of range over the 5-year period. They would end up at kind of a more sustainable level of 0.33, which I think makes sense for them. And as is the same with the other two financial companies we did, JP Morgan and Citigroup, they both have pretty substantial default risk, which comes off of the back that they do have large amounts of debt as basically the kind of the prime resource of their business. They kind of, as I had said, they have to take in capital in the form of loans and then loan it out at interest at other rates, and so by nature they kind of always have a large amount of debt. It really just comes down to being able to manage that. As we had said before, JP Morgan was a little bit of the exception of actually having a little bit lower levels of debt, relatively speaking, but seeing both Goldman Sachs and Citigroup with over 3% in default risk expectations per year because of their debt levels is not entirely to be unexpected. So I don't actually necessarily punish them for the per year default rate expectation. I really just kind of allow that to filter its way into the actual expected value, and then as long as the valuation is good, I'm willing to kind of like give them the benefit of the doubt as far as that goes. And as we had kind of commented once I was doing one of the final summary on the last valuation, somebody had kind of commented it that in and of itself is very much a reflection of what people call too big to fail, is that these companies have huge amounts of debt. That debt itself has a pretty significant amount of default risk, but because of their position in capital markets or in consumer banking, they kind of inherently can take on these huge amounts of risk, and the entire financial apparatus is expected to just kind of deal with it. And the only way in which the valuation itself gets adjusted for that fact is really just the fact that we have, as I said, these huge costs of equities assigned to the company because of the way that we apply the debt to equity ratio into the expected risk of the company, the levered beta. So anyway, that's basically all the assumptions that are relevant for the total valuation. As I had kind of said when I was talking about my rule of thumb for returns on invested capital, whenever my non-cash equity is negative, I kind of just take the most recent returns on invested capital and cut it in half and think about that as maybe a more sustainable return on invested capital, which gave me about a 10%. And then comparing the actual assumptions of my valuation, revenues, margins, and capital assumptions, the expected return on invested capital I would get at the end of the 5-year period is about 7 to 8%. So I think that assumption kind of makes sense then, because I'm kind of coming up with a return on invested capital that's in at least the same ballpark range. It's a little bit lower than that 10%, but at least it's kind of in the same ballpark. So with that, we can come over to the final summary of the valuation. And if you're watching up to this point, either live or on replay, be really, really appreciated if you would give us a like. More likes attract more people to the channel. And that's just the number one thing that YouTube likes to see on content, to help spread it to other people. And if you're not already subscribed to the channel, please subscribe to the channel. That way you get notifications whenever I go live or when I release other videos and other content like that. And also you can find the pinned comment in the chat, and also in the description below is the link to the Discord. You can join the Discord, where we like to release daily news, have discussions about things going on in the market, our company analysis, or details related to our portfolios or other major investments, investors and things like that. So join the discussion there. So the final summary valuation: Goldman Sachs, GS, ticker GS. The 10-year treasury is currently selling for 3.26% today. And mature market equity risk premium I come up with currently is 5.56%. That's still moving upward. And then the discount rate for Goldman Sachs specifically, after adjusting for company specific idiosyncratic risks, is 17.25%. So pretty significant default discount rate off of the back of mostly just a very, very large debt to equity ratio. Their current dividend yield forward expected is about a 3% yield. 5 years ago, they had sales of $37.7 billion. In the most recent year, it was $64.6 billion, which equates to sales growth of 11.38% on a compounded basis over the 5-year period. The sales capital ratio over the last 5-year average has been 0.19, compared to the sales to capital ratio expectation for their industrial grouping in the most recent year of 0.61. So relatively low sales to capital ratio over their historic period compared to the most recent year of their industry, but that is a little bit apples and oranges, being not year-to-year comparison. Return on invested capital, as I just kind of explained in summary, an estimation on my part due to the way that I estimate when certain pieces of information are not available to me, about a 10% return on invested capital over the 5-year last period as an estimation. And their debt to equity ratio is currently 232%, which gives them about a 1% default risk in the most recent year period, partially low due to the fact that they have pretty significant profits in the most recent year. Their profit margins over the longer term time frame average has been about 21%, compared to their industrial expectation of the most recent year, about 15 to 16%. So a low sales capital ratio compared to their industrial expectation, but a high profit margin relative to their industrial expectation, and high profit margin over the longer term too, and the shorter term even more so. They had like 32% in the most recent year. Profit in the most recent year was 21.6 or 21.1 billion dollars or so, and they're currently selling for $333.50. Probability distribution that I'm using to apply to my valuations is our pretty standard normal distribution, with most of the weight in our median third model. Our revenue expectations based off of a correlation between interest rates and revenues gets us a worst case scenario of anywhere from 53.5 billion to a best case scenario of 96.9 billion, and on an expected basis we see 73.9 billion. That gets us revenue growth of anywhere from -3 to -4% in the worst case scenario to possibly 8 to 9% in the best case scenario. On an expected basis, we see about 2 to 3% per year on a compounded basis. Our sales to capital ratio on expected is about 0.33. So we do expect it to decline from the most recent year, but to be relatively high compared to the longer term average, and also bring them relatively closer to their industrial expectation. And the return to invested capital we see on an expected basis about 7.86%. So a little bit of a decline from our approximation that we had for their most recent year or so. Our debt to equity ratio assumption we see on an expected basis, them possibly raising their debt to equity ratio up to about 289%. This is somewhat of us just being a little bit conservative on assuming that their market cap very well might decline a little bit, and or that they might issue more debt in order to fund operations. In either case, that would raise their market debt to equity ratio. And their default risk assumptions based off of all of these models of debt gives us a pretty significant amount of debt per year of about 3.76% on a compounded basis per year. That's again per year. So for 5 years, that would end up being about 15 to 16 or 15 to 20% of total risk of default over the 5-year period. But again, that kind of comes in line with what I was saying before. Such high debt to equity ratios and high default risk is basically where you see too big to fail in the numbers. And that's basically exactly what this is. And then the way that equity investors adjust for that is by giving them a much higher discount rate. And so that would theoretically be covering for those risks. Our profit margins, we have a distribution of anywhere from 10% to 35%. And on an expected basis, we see about 23 to 24%. That gets us a profit distribution of anywhere from $5.3 billion in the worst case scenario in the 5-year forward period to possibly up to $33.9 billion in the best case scenario. On an expected basis, we see 17.5 billion. And then that gets us, using the discount rate applied across all of the various scenarios that we have applied here, a present value expected price of $332.70 per share, which is basically almost exactly where we are right now. Basically only 80 cents difference off of a $300 per share stock. So less than 1%. It's pretty much right on the money right now. 5-year forward value targets unadjusted for the dividends that they'll pay out during the period. It gets us a worst case scenario of $365.43. In the best case scenario, we see $1,488.05. On expected basis, we see $737.19 per share. Comparing that to the current share price and applying the discount rate on expected basis, that gets us an implied return for the next 5 years of 17.19% per year. And so, yeah, like I said, discount rate was 17.25%. So there basically is, their discount rate is what it's expected, which means that the returns you would get, while this is a very large return to be receiving, it is effectively just your risk adjusted return. Because again, I mean, look at the risks. The risks are right here. The huge amount of debt they have on hand, and then the huge amount of potentials that there's going to be problems on any given year with their ability to pay their bills related to said debts and the management of their assets. So very, very strong returns available for Goldman Sachs, but definitely not so much so that you're getting more than you deserve, essentially speaking. I mean, out of the 3 companies, I would say it's like looking between the 3. We can kind of take a look at the summary pages. For example, Citigroup has even higher expected returns, but they actually are not fully risk adjusted. So you could say that Citigroup has a higher risk, but also has even more reward, or so to speak, or it might eventually have more reward, but it might be a very painful way to get to the reward. Goldman Sachs has just as much risk and reward as it ought to have, theoretically speaking. And then Goldman Sachs also isn't fully risk adjusted, but it doesn't even have all of the fully expected returns because to be honest, there's just less expected returns for Goldman Sachs because they have way less risk inherent in their default to begin with. So it feels like the market itself is just appreciating Goldman Sachs JP Morgan much more than it is Citigroup or Goldman Sachs. If I was gun to my head, somebody said I had to buy one of the 3, I think I'd buy Goldman Sachs. Because it does have pretty significant high expected returns, but they're at least reasonably risk adjusted. Comparing the yields also between the 2, I mean, it has the lower of the yield, which means a little bit less of cash flow in the short term. But in another way of sort of a rating of markets, you could also argue that means that markets are rating the cash return of Goldman Sachs as lower risk compared to the other 2. That's not entirely fair to compare because buybacks have an effect on the way investors think about those things. So we would almost maybe have to take into account the expected buyback between the 2 as well. And if we do that, for example, JP Morgan and Goldman Sachs look like they have similar amounts of yield, whereas Citigroup doesn't even have any amount of buyback authorized. But like I said, there's just different ways of thinking about how the market might be rating the companies themselves. Obviously, there's also just flat out PE ratios to take into account. Goldman Sachs is currently trading at about a 5.5 accordingly to the way that I'm calculating it. We can see that JP Morgan is trading at a 7.3 or so, and then Citigroup is trading at about a 4.3, 4.4. So just off of that alone, JP Morgan definitely appears like it's the one that people have the highest amount of trust in, relatively speaking. But Goldman Sachs, I guess you could say, comes in second. So yeah, I don't know. If I had to pick one of the 3, I'd go for Goldman Sachs, but I'm not going in on either of the 3 today. So anyway, that's gonna be it for the Goldman Sachs valuation. I did put all 3 of them already into the watch list, so they are already all listed in here and have been for a few days. They're kind of up in here. I mean, I had listed them when we were kind of showing it by sector, but showing where they are on down here. Some of them are further down the line. I guess I'll just list them like that way so I can find it a little bit easier. Financials, yeah. So Goldman Sachs, we got it listed right here. It's 0.66. It's actually not far off from the same level of Citigroup, was 0.61. And then JP Morgan was at 0.86. So yeah, we can kind of comparatively see like that. Let's see, Citigroup and Goldman Sachs compares with maybe Apple, Big Five, Garrett Motion. Yeah, kind of in that range. HP, it kind of trades relatively in line with those as far as the value score goes. And then JP Morgan's a little bit higher than that. It's a little bit closer to the index itself. Yeah. So that's going to do it for the valuation today. As I had said at the start of the stream, I am already planning to do Samphire Resources next. That's the one I have planned already. I've got basically it actually already squared to go. That's going to be on next Tuesday. And then after that, I'm not 100% sure what we're going to be doing, but I do have a few other companies in my screen over here that I've been interested in taking a look at. Maybe AMCX, that one's kind of been interesting to take a look at, or SBLK or STNE, a few of these other companies right there. But if you had other suggestions of companies that you'd like to see me maybe cover, you could comment it below. You can join the Discord and share it in there as well. And also you can like the stream. That way you make sure that YouTube shares my content around to more people and helps attract more people. And if you haven't already subscribed to the channel, please go ahead and do so. All right, I'll catch you all again next time.